Buy to let. You better keep watching because this beginner's guide is going to give you all the confidence and information that you need to get started investing in buy to let. It might sound really easy. You buy a house, you refurb it and you rent it out, but there's a bit more to it. I've learned the hard way throughout my career. I've made tons of mistakes and I'm sure you still will after you watch this video. But this short, simple guide is going to help you with some of the main problems that you might face during your journey investing in buy to let. So stay tuned and let's go through this with a fine-tooth comb to make sure you've got the best guide possible to succeed in this wealth growing strategy. So let's start with the basics. What is buy to let? Buy to let is when you buy a property. Generally, you'll buy it below market value and add value through renovation, and then you rent it out to a tenant. There's many different strategies and we'll go into this a little bit later on in the video. The main beauty of buying a buy to let and how I've managed to succeed in my portfolio, I'm now on my 10th property, is being able to leverage using other people's money, i.e. the bank, and being able to pay your mortgage through the rent that your tenants pay you. This strategy has worked for millions of investors and is the key to being able to grow a successful portfolio. Leverage and debt will become your best friend, and there aren't many people that can tell you that debt will become your best friend. Right, so without further ado, let's get straight into this one and let's start talking about the two main ways that buy to lets are going to make you money. The first one is cash flow. Cash flow is the way that we operate. It's the way that we bring money into the business on a monthly basis. This is the rent, and it's calculated by working out the gross revenue, which is the money that is brought into your company via rent usually, minus your operating costs, which gets you to net profit. This is going to be your cash flow. This is the money you make every month. This is going to be potentially, if you're like me, your salary and enable you to leave your full-time job. Everyone wants cash flow, but it's not the only thing. The next one is capital appreciation. This is how properties increase in value over time, meaning that the equity you have in the property grows as well. For example, over the last 10 years, property prices have doubled. You'll know yourself, you'll speak to your nan or granddad and they will have bought a property for what seemingly sounds like £100 and you're like, fuck off, nan. But seriously, they did. And that's because inflation has meant that money becomes less valuable and your buying power is less. So properties become more and more expensive as the buying power becomes reduced. Okay, so next one, and this is really important. This is structure. Now, there's a couple of ways to structure your buy to let, and this is a question I get all the time. Do I buy in my personal name or a limited company? And it is a very good question. If you're buying your own residential property, it's going to be in your personal name, and there is a benefit to that. And the benefit is that when you sell the property, you don't pay capital gains tax. Capital gains tax is a tax that's put on assets that you sell in your own personal name. The capital gains tax rate is now 24%. So if you buy a house for 100 grand 10 years ago and it's now worth 200 grand, you would have to pay 24% if it wasn't your only residential property in your personal name that you were living in, actually. That you were living in. Don't let me forget that one before you all get too excited. So that is a benefit to having a property in your personal name. So the other option is buying in a limited company. In my opinion, this is the only viable option if you want to grow a successful buy-to-let portfolio in 2026. The reason being is back in 2017, the government implemented Section 24. This was the abolishment of the ability to put your mortgage as an expense on your tax return for your portfolio. Now, your mortgage is one of the biggest expenses you will have in your business. So if you cannot claim that back as an expense, you could actually end up being minus or in a negative position month on month on your cash flow. Remember, that is one of two of the most important things in this whole cycle. So you need to buy your property in a limited company structure, in my opinion. It also has protective entities because a limited company is limited in liability. So it's away from your own personal being. Okay, so number 3 is mortgages. So buy-to-let mortgages. This is going to become one of the things that you are going to use more than likely to grow your strategy, because if you don't use these and you use cash, then it's going to take you a hell of a long time. By the time you grow a portfolio of 10 like myself, you're going to have grey hair. You might already have grey hair, but you'll probably be in your box, to be honest. So you're gonna have to be using buy-to-let mortgages. Now there's a couple of different ways that you can use buy-to-let mortgages. There's repayment or interest only. Now repayment is the safer option, okay? You may think it's the safer option. It's the way you've been told that you should use a mortgage. You should repay and pay down the debt so that you have a property that has no debt on and all of the rent is yours. Now that might work for some people, and if it works for you, then absolutely fantastic. But if you want to grow a portfolio of buy-to-lets, then I would seriously recommend going on an interest-only mortgage. Now an interest-only mortgage means that you only pay the interest on the mortgage at the time the rate was set if you go on a fixed term. So it's normally a 2 or 5 year, and that will be on a fixed rate. At the minute, base rate is around 4%. So my buy-to-let mortgages, they're normally a little bit more in a limited company. So I'm looking around 4 to 4.5% on my interest rate. So fix it in, and I don't repay down the debt, I only pay off the interest. But this is still good because remember, number 2, the other reason why property investment is so good, capital appreciation, my debt will stay the same, but my property will appreciate. So if I buy a property for 100 grand and I use a 75% loan to value, so I borrowed 75 grand, 25 grand down, if it doubles in 10 years, it's now worth 200 grand, I have still gained 100 grand in uplift, so I have 125,000 pounds in equity in that property. Now that nicely brings me on to deposit. The other thing about buy-to-let mortgages is they usually require a higher deposit. So instead of your residential where you may be able to get a 10%, even a 5%, I believe, during COVID and the inflation hike where money was given away like nobody's business, it even went down to 5%. But in a buy-to-let, it is 25% deposit. So you have got to take that into account before you start investing so that you can be realistic. But there's ways to get around it. This brings me on to strategy. You may have heard of 4 letters, BRRR. This stands for buy, refurbish, refinance, recycle. Now, the way you buy, there's 1,000,001 ways that you can buy a property. You can buy it cash, you can use a bridging loan, you can use a mortgage, you could raise investor finance. There are a load of ways that you can buy property, and I will make another video that describes the methods that you can enter into the property market. Then, generally speaking, you're going to do a refurb. You're going to add the value to this property. That means that you're going to try and get the equity out on the back end by adding the value. This is a refurb. It could be as simple as putting paint on the walls, or it could be a back to bricks, full-on renovation to try and increase the value at least 25-30% on the back end. Then you're going to refinance. This means that you're going to get the bank to do a valuation and you're going to refinance, remember, at a maximum of a 75% loan to value. Loan to value is the amount of money that a bank will borrow you as a percentage, as a reflection of the purchase price. Remember, 25% deposit, so they will borrow you 75% of the purchase price. So you're going to refinance. This is bringing your money back. Now the last all is recycle or repeat. You've got your money back and you go again. I didn't start off with millions of pounds, but I do have millions of pounds worth of property. And the reason that I've managed to be so successful is following these 4 simple key terms. So I would really advise that you do the same. So now going into strategy even deeper, there are multiple strategies within buy-to-let. Are you focused on monthly cash flow or capital appreciation? If you're focused on capital appreciation, you're going to be wanting standard buy-to-lets. They're not amazing on cash flow. You might make £300 or £400, but you can guarantee that the bricks and mortar valuation will go up over the next 10-15 years based on historical data. Or if you're looking at cash flow, you might want to go for a strategy like HMOs. Now, I diversify my portfolio. So I've done HMOs and I've got buy-to-let. I've also looked at assisted living. There is no strategy that I won't try out if I don't think it is the right strategy. I've done flips, I've done buy-to-let, I've done HMOs. So it's about finding the strategy that works for you, making sure you do your due diligence, but realizing that there is a strategy out there that will suit your specific needs. Now, searches. Make sure that you do your specific searches on the property before you purchase it. Now, I've made this mistake before. I purchased my first property in cash. It was 55 grand and I was a beginner. I bought the property and I didn't do a mine search. This was the biggest mistake I'd made. It turns out that the property had a mine shaft within 20 meters. This means the property wasn't mortgageable. I thought I was going to lose everything. This was a 55 grand purchase. I'd put about 5-10 grand into the refurb, and I honestly thought my money was trapped and I'm not going to be able to sell this property anymore. Luckily, I managed to break even and sell it a few years later at auction. It had brought me in cash flow, but I could have avoided all of this headache by just making sure that I did all of my searches beforehand. And make sure you do a mining search. I obviously make sure I do one every single time now. Okay, so now we've bought the property, we've done a refurb, we're doing the full BRRR, and we're now letting it out. Let's look at the legalities and responsibilities. So you've got to make sure that you have a gas safety cert done at least once every 12 months. Electrical certification, so an EICR, has to be done once every 5 years. Your EPC rating is valid for 5 years, and it has to have a valid EPC rating at the time of getting a new tenant. If an EPC rating does expire whilst you've got a tenant in, there is a bit of leeway, but as soon as you get that new tenant in, then you do need to make sure that it's refreshed. And the EPC rating has to be a band E or above. You've also got to make sure that you've got your right to rent checks done. So this comes into your due diligence, and you've got to make sure that your property is a safe and inhabitable place for your future tenant. Now, bit of advice, when you're doing your checks, if you want to be the landlord for your property, I've always used Open Rent. Now, Open Rent provide a service that means that they do the reference checks for your tenants. So go onto Open Rent, go down to landlord, click on referencing, and it costs £30 per tenant to do the referencing checks. And that £30 will be the best you've ever spent when you're sitting at home knowing that your rent is paid by a legitimate and good tenant. Don't forget, buy-to-let is a business and it's got to be run professionally, and if you do run it professionally, there can be money made without the headaches and without the worries. You've just got to make sure that you systemize it beforehand and have it set up in a really clean, squeaky clean manner to succeed. Okay, so the big question, is buy-to-let worth it? In my opinion, absolutely 100% buy-to-let's worth it. This is what I do for a living. It's given me the freedom to quit my day job and answer to no one. It doesn't come without its list of problems, but let me tell you about my last deal. I bought a property for £100,000. I spent 50 grand on the refurb. I refinanced the property for £210,000. That means that on my 75% LTV, I got 165 grand back in my pocket to go again. Remember, recycle. And now it rents out for £1,250 per calendar month. So I'm making over £600 per month on a standard vanilla buy-to-let. That is insane. Look, these deals are hard to find, but I'm sure any of you out there watching can do it if I can do it. It just takes a little bit of time, and make sure that you're doing and following this checklist to ensure that you're compliant and you're doing everything right to ensure you're just as successful as I've been in the last couple of years. And I'm really, really glad that I took this path because I love it. Guys, I really hope you've enjoyed this video. If you have any questions, put them in the comments section and I'd be happy to answer them. Also, if you enjoyed it, then make sure you give me a subscribe. You guys take care and best of luck on your buy-to-let journey.